Okay, peeps, welcome back. So today we're going to be talking about investing in high yield dividend paying stocks and ETFs and the pros and cons and implications of doing so. So with that being said, let's get it. Okay, so I recently watched one of our favorite grayscale guy who always talks about the grayscale trusts, Ethan, and there was something going on between him and somebody else. I don't want to get into it, nor do I want to be a part of it. We don't want to be a part of that, but there were some interesting things that were brought up that I do think um, we're going to go over today, and that is understanding like total return and tax implications, qualified versus non-qualified dividends, and let's see, expense ratios and stuff like that. And when it comes to investing in high yield dividend paying stocks that potentially have NAV erosion versus ones that don't, or lower yielding stocks and or dividend growth stocks. So let's go ahead and get into it. So the first thing I want to show you guys here is total return. So for some reason, this doesn't, it's not really optional to see total return on Robinhood. You kind of have to do the math on your own, but on M1 Finance, they have it automatically kind of built in here. So you guys can see total return on some of these. Some of them are negative, some of them are positive. The thing I want to point out here is that you guys can see Tesla is still down 26%. We have not added any money to this since last year. So at some point, the dividends will outpace the price performance of the stock. But as long as the stock performance or the fund performance is going down and or flat, it's going to take a little bit longer for them to kind of balance themselves out. So if we compare that to, let's say, NVIDIA, you guys can see Tesla is down 26%, but NVIDIA is actually up 99%. Now, we took profits on both Tesla and NVIDIA on this particular account. So actually Tesla should probably be a little bit closer to, I would say 22, maybe 23%, maybe even 20%. Again, I don't have those numbers pulled up, but we'll just take a look at it real quick and then I'll get into this other stuff. So you guys can see that the market gain on Tesla on this particular platform is the drop is pretty substantial. So it's minus $4,800. Again, Tesla is underperforming because of the Fed funds rates. I mean, it's really just that simple. So the dividends, 3,165 for people that's looking to both cash flow and get price appreciation. Ideally, you want to see both of these in the positive. So they kind of give us a total, basically an estimate of what our money weighted return is, which is basically that whether there's a price gain or a price loss, and calculate that in confluence with the dividends. So I pretty much want to point that out. So a quick snapshot. If I go over here to Robinhood, okay, so I want to point this out in terms of some funds. All right, so you guys understand. If you're looking for something to invest in with high yield, either high yields and or like dividend growth or something like that, theoretically, you just click over to the max time frame. If you see something like this, obviously, enter at your own risk. If it's generally going down, it's usually not a good sign. So for people that want to kind of avoid the NAV erosion thing, looking at the charts is always a good idea. If I compare that to something like NVIDIA, say, for example, you guys can see that NVIDIA has gone up over time. Another few good examples that we could look at here is, let's say, YMAX. Just got to wait for it to load. I don't know why it's taking so long. So YMAX is down a little bit, but again, in terms of total return, it's only down slightly. And we have seen lows like this before, and it's managed to recover. The point here is that it did recover. If it recovers in the short term, there's a good chance it's going to recover in the long term. No guarantees, but generally a fund that goes flat, meaning sideways and or up, is always your best bet, especially when it comes to dividend yielding stocks. So if I go to FEPI, this is another popular one that a lot of people invest in. We have this one as well. We have, I think, roughly about 100 shares of this. So you guys can see that FEPI is actually up. So it started at 51.67, kind of dropped off a cliff, and then pretty much just moonshot after that. And the last one I want to show you guys here that we also have is QDTE. So QDTE more or less has looks like pretty much mostly been flat. I mean, it's down a little bit, but of course these funds are going to move with the price of the Nasdaq or whatever index or instrument they're tied to. Um, Generally speaking, the idea here is that you want the total return to be positive. Okay, so either the dividends have to outpace the NAV erosion. Okay, so you have to be making more in dividends than the price of the stock's going down, or neutral. That's probably, I would say, probably worst case scenario. If your total return is negative, obviously that's not great. We're stuck in that situation with Tesla, but we are bullish long term on Tesla, so to each their own. But with funds that are going sideways and or flat, if the dividends is outpacing the flatness of the fund, then theoretically your total return should be positive. Now, best case scenario, obviously, is if the fund is going up and you're also receiving dividends, like one that we're looking at, for example. See if I can remember what it is. I think it's called GPIX. So this is the Goldman Sachs covered call ETF. So if I take a look at the max time frame on this one, you guys can see that the price appreciation has been absolutely insane. So this would be the best case scenario. Get something like this that goes up over time. The dividend's not as high, so there's room for the price to run. And then there it is. Best case scenario, price goes up and dividends also pretty substantial as well. So a couple examples I want to show you guys of actual real examples of how to look at these funds. So you can see we're priced negative here, $610. On Clip, we have not added a lot of money to Clip or any money to Clip really in a long time. Price is currently sitting like $4 below our cost basis. We can add any at any point in time. But if I go over here to the dividends tab, and again, I could be mistaken. Maybe it's on here somewhere. You guys can point it out to me if you know if it is. But I'm pretty sure Robinhood does not have a total return tab, so you can see all the dividends that we've gotten over time. You guys can go back and double check these numbers on your own to see if they're accurate, but we've held this fund for roughly about pretty much going on a year at this point. So we have our negative price return here, right? And then we have the total dividends that we got paid here. So if I subtract the total dividends that we got paid, and again, this is just Clip on one of the accounts, not both, minus the current drawdown in the price, you guys can see that our total return is actually plus $324.31. This is always our goal. I'm not going to tell you guys what should and shouldn't be for yours. You can make up your own mind about that. But total return does matter significantly. I will say that. Now, if I were to compare this to something like, let's say, NVIDIA, okay, sorry guys, this is really taking forever. So as you guys can see, NVIDIA's price performance has been absolutely stellar. Why is that? Well, it's quite simple, because NVIDIA's price performance has been stellar. So like we told you guys a long time ago, how these funds will perform is based on a couple of things. It's based on macroeconomics. Okay, if the Fed's tightening rates, that's usually going to be bearish for the economy. Okay, some of these stocks may be dependent on cheap monetary policy. And if the Fed's tightening rates, that might have a bearish effect on some of these companies like Tesla, for example. Okay. But as soon as they start printing money, they get to the point where they say, okay, we're going to cut rates to zero and we're going to start printing money. Then that's theoretically, in my opinion, a QE bull market, as we've said before. Likely when you're going to see all of these stocks run to their absolute maximum in terms of price appreciation. So pretty much any discounts that you may get at that time. And again, I can't guarantee this, but pretty much almost all discounts on these stocks will be gone, in my opinion. But you guys can see that the price of NVIDIA has been absolutely exceptional. It's been plus 43% versus Tesla's minus 37 or whatever it was. And I can actually show you guys here. So currently in a drawdown on NVIDIA, $63, as you guys can see, and we did add more in terms of shares. And that's just because of the recent pullback in NVIDIA, which that's going to happen because, I mean, it's a hot stock. Everybody's buying it, trading it, all that stuff. So there will be pullbacks along the way, even in a bull market. Expect that. But here's the dividends. So you guys can see that the dividends have actually far outpaced the drawdowns. So again, basically 250 minus 63 here. What matters in this instance is total return. If your total return is positive between the price appreciation of the stock and the dividends, then that's always a good sign, right? Nobody wants to lose money. Everybody wants to make money. So the important thing I want to point out here is that total return matters. Okay. So the other thing I'd like to point out is also the expense ratio. So when you're investing in these high yield funds, consider the expense ratio. We don't talk about it too heavily here, but we have mentioned these in previous videos. So as you guys can see for Tesla, and I'm pretty sure all of the other single stock ETFs, the gross expense ratio here is 0.99%. So if the distribution rate is 49%, pretty much just take 1% off of that. So you're actually looking really at 48.4%, which is still good. If you take the 1% off the 49% and it comes to 48%, let's say the stock price is up 10%, but you also get a 48% dividend, well, your positive total return 58% on the year. Okay. So that's the way to think about it. So, I mean, a lot of these high yielding dividend paying stocks are, they're a little bit more expensive. So 0.99 for the Defiance ETFs. If I go down to Clip, you guys can see it's 0.95. So they're all quite expensive. FEPI, this one's actually a little bit cheaper. So this is one that we like a lot. It does have a little bit of price appreciation, but also has some pretty great dividends too. So 0.65% on the expense ratio. It's a little bit less. Dividends are pretty good, as you can see. QDTE, distribution rate 25%. And I'm just going to go over QDTE, not actually the S&P 500. Let's see here. So you can see the dividend rates down here. So roughly about 20 to 30 cents per week for this particular fund. So I'm looking for the expense ratio. Where is it? Here it is. Okay, so 0.95%. So pretty much just take the 0.95% off of the average distribution rate, which again comes out to 24%. Now this distribution rate may not necessarily be accurate for the year because likely, with the options, it's always going to change because the options payouts are always going to be different. We trade options personally, so I can tell you all that the payouts for options are not going to be the same week to week because the price of the underlying stock moves. And depending on what direction it moves, it may pay more for puts or calls. So you just have to learn to adjust this over time. They typically do it for you when there's a fund, but as you guys can see, SPYI, another one, 0.68. So expense ratio matters. But like I said, if the total return between the price appreciation and the dividends is far outpacing the expense ratio, not a big deal. But obviously, if your total return is negative, maybe not such a great thing, right? Maybe you want to, if it was me, I would want to reconsider maybe getting into a different fund. So we talked about expense ratio. We talked about the dividend yield. We also talked about total return. So let's get into the qualified versus non-qualified. Again, we don't like talking about taxes too much, but it does matter. It matters for every individual person, every individual investor, depending on their situation, to understand the tax implications of what they're investing into. Now, I can't tell you how these are going to be taxed, whether they're qualified dividends or non-qualified dividends. It's probably something you'd have to ask the fund managers. They would have the answer to these questions. But I want to point this out so y'all can understand this. Okay, so qualified dividends generally are taxed at favorable tax rates. Okay. Qualified dividends would be things like dividend growth stocks like maybe Pepsi or Coca-Cola or something like that. I don't know if some of these higher yielding ETFs would be considered qualified dividends or not. So they have something here that says, basically to qualify, you must hold the shares for more than 60 days during a 121-day holding period. I'm assuming that's a holding period that starts 60 days before the ex-dividend date. Again, this is probably talking about quarterly paying dividend stocks or dividend growth stocks. And they say that there's certain kinds of stocks that don't make the cut in terms of qualified dividends, which could be things like REITs, master limited partnerships, and some other things, maybe even business development companies, although I'm not sure about that. Generally, when you invest in dividend paying stocks, you should receive some kind of 1099 DIV form. We did get one last tax season, so that is common. Again, I can't speak to if that's specifically going to be the form you get. That's up to the investment exchanges and also how the fund managers go about deciding whether those are qualified or non-qualified dividends. But you guys can see that for the qualified dividend tax rate, it's very favorable. So 0 to 47,000, 0%, 47,000 to 520,000, 15%, and 518, well, not exactly 520, but 519,000, 15%, and then 519,000 and above for single people, 20%, and then adjust all these numbers accordingly, whether you're married, head of household, separated, or married, filing singly, or separately, I should say. It kind of varies based on your situation. So in terms of non-qualified dividends, non-qualified dividends are usually taxed at regular tax rates, okay? So you guys can see the standard income tax rates here, and of course the amounts here. And then of course it also depends on your marital situation. So these are important things to understand. I can't be sure of this. Maybe the high yield dividend ETFs, a lot of them, maybe they are considered qualified dividends, but again, we don't generally hold our positions for like 120 plus days unless we're not taking profits. Some people just want to hold these and never sell. In that situation, maybe they'll be qualified dividends, but again, that's something you would have to ask your CPA, ask the fund managers, and find out from whoever you hold your assets with, whether it be M1 Finance or anybody else. So once again, it shows you guys some of them that may be considered non-qualified dividends would be things like certain foreign companies, distributions from certain U.S. entities such as REITs and master limited partnerships. Already went over that. Employee stock options, special one-time dividends, probably a few other things too, I would guess. So that's the tax implications. So now I also want to go over macroeconomics and how they affect the price of the stock. Okay. So give me a second. We got to let this thing load. For some reason, it's taking eons to load. I don't know why. I think it's just the weather, man. It's like really freaking hot here. It's like, I mean, dude, I got a tank top on and it's scorching hot in here. So, again, the price of NVIDIA is going up. That's the reason why the price of NVIDIA is going down. Tesla, of course, the price of Tesla is going down. So that explains why the price, not the dividend, well, the dividend's going down too, but the price itself on Tesla is also going down. So once again, the performance of the yield max ETFs or any of these things are going to be tied to the performance of the underlying instrument, whether it be an index, a stock, whatever the case may be. Okay. Indexes, something like YMAX or let's say SPYI. Of course, you got to look into the fund, understand what you're getting invested into, understand if it's diversified. Okay. But diversified ETFs generally are less volatile and less risky to the downside than single stock ETFs. And if there's a bear market, which I'm not saying there is, but even the strongest stocks in the market have a risk of selling off. Okay. So during basically when the Fed came out and said they were going to raise rates in March of 2021, we all know this happened. From that time to basically the time when the Fed stopped raising rates, or roughly about there, 68% drop on NVIDIA. Okay. Or NVIDIA, I should say. So Tesla, same thing. We can look at that. Pretty much going all the way back here from here to the absolute bottom on Tesla. You can see Tesla itself went down 75%. I can actually show you guys just a couple of more. I'm not going to go over all these, but I just kind of want to reiterate the point that even the strongest companies in the world and the United States, the strongest companies on earth, are susceptible to the Fed funds rate. Okay. So again, Apple in November, you guys can see from the top to the bottom on Apple, this is considered to be the golden child of Wall Street. Okay. Still minus 32%, roughly about the same amount down as the S&P 500 was at that time. Amazon, I know this is another popular one that people love. And, we do have some AMZ. So you guys can see Amazon got absolutely crushed from the top to the bottom, 57% down. I mean, I could go over Coinbase, but obviously Coinbase really got destroyed. I think this thing went down like 90% or something. But of course, Bitcoin hit its top roughly about in November 2021 as well. So 92% down. Another one I want to point out that a lot of people think is relatively safe that is also at all-time highs, and I would say it is safe so long as we don't have some crazy bear market, is Meta. Okay, so from the time, roughly about the time that the Fed said they were going to raise rates to the bottom on Meta, minus 75%. So you got to understand, these high yielding dividend ETFs or single stock ETFs, they're for people that cannot afford to actually write options on the actual stocks themselves. Okay. So if you wanted to write a covered call on Meta, it's $494 a share. So you need 100 shares to write a contract. Okay. So that's $50,000 to write one contract. It's much cheaper for most people to just go buy FBY or some other kind of single stock or diversified high yielding dividend ETF than it is for them to, somehow get 50,000 and then go do their own options. So there's that. Okay, so YieldMax is trading the options for you for an expense or whatever. Any of these funds are doing it for a small expense. You're paying them for their expertise, their time, and their knowledge and their performance in the markets. Okay, that's the first thing. The second thing is it's very expensive to trade these big tech stocks. I mean, even the cheapest one right now, NVIDIA, $126 a share. You would need $12,600 to write a covered call or $12,600 to do a cash secured put. That's a lot of money. Most people don't have even a fraction of that. So it's easier and cheaper to buy something like NVIDIA. And there are risks involved. If the stocks go down, whatever the fund is that's mirroring the price of the stock or the market or whatever it is going to go down. If it goes up, then the fund is going to go up. Okay. The other thing I want to point out is that during a bear market, nothing's really safe. If I'm being completely honest, even the biggest, strongest companies in the world, as you guys can see, got absolutely smashed. So if that happens, likely the fund that is trading the options on these particular instruments is also going to go down. Okay. The only saving grace here, I would say, is that the fund that is trading the options for you, that's paying you dividends, technically options premiums, you have that passive income to offset the drawdown in the price. And the thing that we've learned from Tesla over time is Tesla's gone down a lot because Tesla's gone down a lot, but it has still paid dividends over time. Granted, the dividends have reduced. I would say that's a risk. Obviously, nobody wants that, right? But the passive income is still there, so we have that history to rely on. And of course, I would like it a lot if the YieldMax would come out with some kind of inverse ETFs, some short ETFs, or basically a way for investors to hedge against the potential drawdown in the long version of the ETFs. That would be nice. I know I'm not the only one that mentioned that. So anyways, you guys let me know in the comments below what you think about that. But this is kind of the pros and cons of investing in these high yield ETFs and understanding the different implications and how to understand and kind of calculate and strategize all this stuff. So anyways, hope y'all enjoyed this content. Please like, comment, and subscribe, and we'll see y'all later. Peace.